All right, first-time home buyers. Next question for Jay is going to be my credit score. What is my credit score? Why is it important? And how does this thing affect the interest rate I'm going to be able to get or the loan I'm going to be able to get? Have it, Jay.
Okay, first of all, it's important to know what credit scores are. Okay, credit scores are risk of default scores. Okay, and there's a zillion of them out there. Okay, so if you went to Credit Karma or something like that, you got a score. You get a credit card statement, you get a score. And Credit Karma is a different thing, but you might see something that says it's a FICO score. When I'm doing a loan, I'm pulling up your FICO scores from Equifax, Experian, and TransUnion. And it's like the Olympics, we're going to throw out the high one and we're going to throw out the low one and use the middle score. And that's what's going to drive your eligibility for programs, your interest rate, your mortgage insurance rate, stuff like that. So it's important to have those good scores. The score you see on your credit card statement is not going to be the score I get. Okay, it's different. FICO has like 3 dozen different algorithms to calculate those scores. But how does that affect me? So, obviously the higher the score, the better.
Sure.
Okay, but I think in terms of somebody wants to think if I've got excellent credit, then I'm thinking like 760 and above.
What's the highest you can possibly get?
850.
850 is the top.
Yeah.
So what's a bad score, or let's just say what level would be a score that you're probably not going to qualify for a mortgage loan?
I usually say that you're flirting with trouble below 620.
Okay.
You're going to be ineligible for a lot of programs if you get under 620.
So if you're pumping into the 7s somewhere and you're getting higher in the 7s, you're looking better all the time.
Right. And it makes a difference on the program, whether it's conventional FHA or USDA or VA. So for instance, on a conventional loan, if I've got a 760 or 780 credit score, I'm going to get, in theory, the best interest rate and the best mortgage insurance rate. But if I'm with 720, which is not a bad score, you're going to pay higher. And your mortgage insurance is going to be higher.
Wow.
And if you get down into the 600s, the mortgage insurance will be exorbitant.
Wow.
Mortgage insurance is really cheap if you've got good credit. It's not the horrible thing that people make it out to be. But if I've got a 660 credit score, the mortgage insurance on a conventional loan is going to be way high. But if I go FHA, everybody gets the same.
Gotcha.
Mortgage insurance on FHA is the same whether my score is 850 or 650.
The mortgage insurance premium with FHA is pretty hefty, but it's just the same for everyone.
Well, it's not too bad. It's 0.55%.
Okay.
So that's not too bad.
All right.
I mean, it had been higher a few years ago. They adjusted us from time to time.
Is there any situation where a first-time home buyer, you look at their credit and it's right on the verge or on the edge, or it's like it's kind of lowish, but you can qualify? Is there any advice anytime to say maybe it's good to wait, and because there's some basic things that you can do? Maybe there's a car loan nearing the end of the loan program, or different things that could be paid off that could improve that credit score. Is there situations where somebody should wait, improve, and then come back?
Sometimes I have a drawer full of people in that category where we say we need to either establish credit because we have none.
Okay.
And I'll just say for a moment, the way to establish your credit score when you're first starting out is credit card. Okay. And even if you've had a couple car loans in the past or something like that, you need a credit card for your credit scoring. The credit scoring pie, 35% is how you make your payments. Have you made them on time? 30% is how you handle your credit cards, your credit utilization. So if you don't have a credit card, you're missing out on points. You just can't get but so high. But yeah, I look at people all the time and say, hey, we can do this. We can get some extra points out of this. And we've even got some tools with our company and a person that's an expert at this that'll review it and say, do this, this, and this, and this is what we estimate. We've got some estimators, stuff like that. So but oftentimes I can look at something and say, okay, your credit score is 550. You need to get a credit card.
Right.
These credit card balances need to pay down. If you've got some serious delinquencies, bankruptcy, 90-day lates, collections, those things are just going to take time to heal.
Yes.
Okay, but some things you can do and get immediate effect from is paying down credit cards.
Would you say if there's a first-time home buyers that have not really obtained a credit card yet, they get one, is it the wisdom, this is what I do, of course I'm older, but you can monthly, you're putting balances on it, but then at the end of every month, you're paying that balance off so that you're not paying the revolving interest credit. Is that the wise way to start that up to get your credit up?
Usually when I have somebody start out and get their first credit card, sometimes it's a secured credit card through the bank or something like that because that's all they qualify
Yes.
for. Okay? I tell them to use it sparingly.
Okay.
And you can pay it off if you want or leave a $10 balance on or something like that. All those things are good. But here's the problem with using it. So take, for instance, somebody has a credit card where they get a lot of airline miles.
Okay.
They say, I'm going to put everything on my credit card, but don't worry, I'm going to pay it off at the end of the month.
Okay.
That's fine. But when I pull up a credit report, it's not giving me the balance at the end of the month you paid it. It's giving me the balance at the time that credit card company reported all their data to the credit agencies. So if I've got a $5,000 credit limit credit card and I rack it up to $5,000 every month and pay it off in full, that's fine from a credit charge standpoint. But at some point during that month, they're going to send that in, and it's maybe your balance is $4,000. That's hurting your credit score because you're at 60% of your credit limit.
So if I could extrapolate from that, so maybe if you're just starting off, you just got a credit card, get some charges on there, and then pay them off at the end of the month. Don't let that balance go way up to start with. Just keep it low, but keep it being paid.
Exactly.
Okay. All right, final question on the credit. You already talked a little bit about this, Jay, but if my credit score is just under the wire, it's not quite good enough, what are some of the concepts? What are some things I can do to improve that credit score?
The first thing I always like to look at is credit card balances. Because that's when I see the credit scores, I see codes as to what's affecting your credit score the most. So oftentimes it'll be something like proportion of credit limits, the balance is too high. Okay. So that means that you're hurting your credit score by your balances being 70% of your credit limit. So you can get immediate relief from a credit scoring standpoint by paying those balances down. Okay. Now, if you've got a recent late or something like that, sometimes it's worth it to call the creditor up and say, hey, give me a break here. I've been a good client. Can I get this removed one time, benefit for being a good client? And that works too. So you get that. My credit expert within our company said one time we had a lady like that. She got a credit card buying their kids some clothes for the school year at the Gap to get the discount and forgot about it.
Oh boy.
And then she had a late payment before she realized.
Oh, no.
First payment was late. And we said, call up, ask them to get a one-time break and remove that. And my credit expert says and if the first person says no, then you call back again. And if you have to cry, you do it, because this is the difference between her buying a house or not at this stage.
Gracious.
Okay? So she called up and got some guy, and he was not sympathetic. Called up again and got a young lady who was sympathetic.
Oh.
And sure enough, they called in a manager, and she got that thing removed, and we got a big 30-point bump on her credit score.
Oh my gosh.
So, but that's a big thing. Those are the immediate things. You can't do but so much when you have late payments. Paying off a loan with late payments on doesn't eliminate the late payments. They're still part of your history. As a matter of fact, I could argue that if you pay off a loan, that may not help your credit score, could hinder it. Because there's a whole bunch of components that go into that credit score, aside from the payment history and the credit utilization with the credit cards. Average age on accounts, mix of accounts, those sort of things, inquiries, all play a factor in your credit score. So, like, I've had people before that'll buy a house, or I'll pre-approve them. So we're selling our house. They sell their house. 6 months later, they come to me. It's like, oh, my credit score went down 30 points. Why? It's like, because your mortgage is paid off now. You don't have that mortgage in your mix anymore. So, it's sometimes counterintuitive, the credit stuff. Back in the day, and like I said, I've become the guy that says back in the day a lot. If I pulled up a credit report, this is before the advent of credit scoring. If I pulled up a credit report and there was absolutely nothing on it, it was like, yes, what a bonus. What a great client. These people manage their life without getting credit.
Right.
Now it's the kiss of death.
Isn't that something?
Yeah.
That's good to know. All right, Jay, thank you again. Such good stuff.
Thank you.